Hey everyone, welcome back to the Hampton Roads Real Estate Channel. I'm Ryan Ponseti, and today I'm bringing you my latest real estate market update. All right, the four things that we're going to cover today are my local real estate market, some key indicators that we always pay attention to here in the 7 cities of coastal Virginia. We're also going to talk about how the recent Federal Reserve rate and its cut is impacting mortgage rates in the short term and the long term. We're also going to talk about home prices and home inventory as well at the end, and how the Federal Reserve rate cut affects those as well. So as always, I like to look in the present where we are currently, but I also do a little crystal ball forecasting about what you may expect in the near future as well. But before we dive in, I just want to remind you to like and subscribe to receive more real estate related content in the future. All right, let's go. Here in Hampton Roads, we have 7 major cities that make up most of the region. So let's take a look at the key indicators that we real estate agents keep track of in order to stay current with the state of our local residential market. Okay. First thing that we look at is, of course, sales price. Our median sales price here is $340,000, and that is down 2.5% from July to August of this year. It's slightly up 1.5% from this time last year. Okay. The next thing that we like to look at is median days on market. This tells us about how slowly or quickly things are moving, and we're right at 18 days on market. That is up 5.9%. So it's getting slower from July to August, and it's been steadily going up. And we are up a lot from this time last year, 38.5%. So things are a lot slower than they were around this time last year. Okay. The next thing that we like to look at is average percent of list price received. That's a mouthful, right? So this has basically been around 100%. So this tells us about how much money the sellers are getting for the sale of their home on average, and they're getting about what they asked for. Okay. And then there's 3 market indicators that we like to look at in regards to inventory. The first one is new listings. This has been flat for the past couple of months, and from July to August, it hasn't moved much at all as well. But new listings are up about 5% from this time last year. So a little bit of a bump from year over year. Our active inventory is slightly up 2.8% from July to August, and it's up significantly, almost 28% from this time last year. So at just above 3,900, we do have a lot more active inventory than we did this time last year, and it's been steadily rising over the past couple of months. That is mostly a byproduct of the market being a little bit slower, though, not so much as having a boost in supply necessarily. And then the last thing we like to look at is month supply of inventory. So we measure the total inventory in residential real estate in months supply. We're just above 2 months, which is not very much. We'd like to be closer to 5 or 6, but it is increased from July to August, 6.5%, and it's up significantly. The August of last year, it's up 36% from August of last year. Okay. So let's turn to the biggest news of last week, which was the Federal Reserve delivering a jumbo size rate cut this week. So jumbo just means that it was double what is typical. They usually do a 0.25% rate decrease. They did a 0.5% this time. So 30-year mortgage rates are affected by this indirectly, and we are just above about 6% on our 30-year mortgage rate after the federal rate cut. So you can take a look at this graph, and you can see that it's gone down steadily over the past couple of months. So what does that mean for the short term of our mortgage rate market? Okay, so this is where we get into a little bit of bad news. In the short term, probably not going to affect mortgage rates drastically. And there's 2 reasons for this. One, the Federal Reserve cut has been expected. So the mortgage rate industry has got their numbers mostly baked in. As you saw on that graph, things have been going down steadily over the past couple of months. They've been expected, basically. Even though it was a little bit larger than they anticipated, probably not going to see a drastic move in mortgage rates. Okay. The second reason why we won't see a decrease in mortgage rates over the short term is that the 10-year treasury bond is actually gone up. And if you didn't know, the 10-year treasury bond has a correlation with mortgage rates. It goes up, mortgage rates tend to go up. A little interesting bit of information for you. The 10-year treasury bond is now higher. The rates are higher than the 2-year treasury bond. For a long time, it's been the inverse of that, which is usually a signal for a recession to economists. Now that there's a flip, that recession signal has stopped, which is a good thing because that's what the Federal Reserve is looking at, right? That's the whole point of them having elevated rates in the first place. But in the short term, that 10-year treasury bond rate going up is going to keep mortgage rates inflated as well. So now, long term, this is where the news gets a little bit better. The Fed policymakers are signaling that they expect the rate cuts to continue, not only in this year, but into 2025. And then they even say 2 in 2026. That's a little far out there for me to really put a lot of stock in, but at least the indications are good that the cuts are going to continue. We might get another half point in total by the end of this year. So we will see more mortgage rate decline, right? And that's what we want to see. Of course, there's lots of opinions about where they might land, the 30-year mortgage rates, but some more optimistic people say that by the end of 2025, we can expect mortgage rates to be in the 5% range. People who are not as optimistic say that it's going to be up in the high 5 range. But in my opinion, if we're anywhere in between 5% and 6%, and we're fluctuating in there, that's a good thing. They've been much higher over the year past. So that's going to help buyers out, even if it's in 5 to 6%. And that's average, of course. It depends on your individual circumstance. All right. So let's talk also about how this is going to affect home inventory over the course of time. So like we just talked about in the local stats for Hampton Roads, month supply of inventory is up, active inventory is up, even new listings is up over this time last year. So the inventory does seem to be getting better. Now, that is a byproduct of the market being slower. So with the federal rate cut, are we going to see a change in that? But experts expect the housing market to eventually heat up. They do not expect interest rate cut to deliver a sudden jolt to the real estate market. So we're looking at more of a gradual, slow burn decrease in mortgage rates, like we just discussed. And so that will probably slowly increase our buyer pool as the rates get better and better. Okay, but what we really want to see for home inventory is for sellers to get back into the market. We've been experiencing for a long time something that we call the rate lock effect or the lock-in effect, depending on who you talk to. But this phenomenon has been caused by the ultra low rates of several years ago to 2, 3, and 4%. And those people have been moving. Of course, why would they? Why would they trade their 3 or 4% mortgage rate for, a 7 or 8% mortgage rate? Doesn't make any sense. But with the rates coming down gradually, hopefully we'll see more people decide to sell, and that will help the inventory. We also need a lot more new construction to come on board to help the inventory, because resales alone won't really cut it. Because if we start seeing a surge of buyers in the market, what's that going to do? It's going to drain the inventory. And what's that going to do to home prices? It will at least keep them where they're at. Like I said, in Hampton Roads, our median sales price is $340,000. If more buyers come into the market, they buy up more inventory, supply and demand, right? Median sales price is going to go up. So you're going to end up paying more for your home, potentially offsetting the benefits of having lower interest rates. So in short, we need more inventory, because as mortgage rates get better, inventory could start going down. Home prices could get worse because of that. So that's the long-term projection there. And that's it for today's market update. As always, I'll keep you informed as new data comes in. Things always change. So make sure to subscribe to the channel and hit that bell for notifications to keep up to date with your most current real estate news. And of course, if you have any specific questions about buying or selling in coastal Virginia, always schedule a free discovery call with me. The link to do that is in the description below. And I'm happy to discuss any real estate questions that you might have. You can also email me. My social medias are also linked in the description if you prefer to message me in that way. Whatever makes you feel the most comfortable. And until next time, be well, and I'll see you out there.